Well, I think there is a real question about whether or not it's actually possible for the government to deliver the scale of cuts that it plans to. Even with the best will in the world, there's a number of reasons why you might think not. First of all, there's the question of whether 25% cuts really just mean 25% cuts in service delivery on the front line, and really they don't, because many public services have high fixed costs, and that means that cutting the money by a quarter actually results in a bigger cut to the services themselves. And secondly, it's not clear that the government can control the costs as closely as it thinks. It can pull certain levers. For example, the Justice Secretary can say he doesn't want people to be on short-term sentences anymore. But if that just results in a few prisoners getting longer sentences, it could mean that the cost of prisons goes up rather than down. And finally, the government is predicating a lot of these cuts on a very radical programme of public service reform to bring markets into public service delivery. Now, in principle, these are good measures, but these things take a long time to get right, and the last government spent, say, 10 years on welfare reform, trying to make sure that the market it produced worked well, and still didn't really get it right. So there's a lot riding on getting it right first time in public service reform, and if they can't do that, it's difficult to see how they won't be back for more tax later on in the Parliament.
Well, looking at the pros and cons of cutting spending so aggressively, on the downside there is a risk that if you cut too sharply it will cause a double dip in GDP. Government spending is worth a lot of overall GDP. It's worth around about a quarter of overall GDP. It can have a significant downside effect if you cut it too rapidly. But on the positive side, it means that if you cut quickly, you will also see long-term interest rates fall. Monetary policy can also offset it. And the point is that we do spend a lot of money on overall relative to GDP, so we do need to get it down. It has risen quite sharply over recent years. We need to bring it back down to more normal levels. Spending is going to be cut, but only relative to previous plans. We are going to see a much lower profile for the total amount of cash spending, but it's still going to go up over the next 5 years. It's just not going to go up as quickly. In real terms, it's probably going to be broadly flat. Now, the important thing is that's still going to have quite a big negative impact on the economy, because over the last 10 years we were spending at a rate of 3 or 4% a year. Now we're spending at 0. That's a very big negative fiscal impulse.